This is another episode of me trading smart, managing risk while learning how to trade effectively. Because if I do that, millions and millions of dollars will yield as a result, and trading will provide me the lifestyle that I've been working towards every single day now for the last year and a half. All right. Today's session was a better session. It was better compared to the previous sessions. As you all know, if you've been tuning into my videos, kind of been struggling a little bit. If I pull up all the trades that I've taken recently, let's go to the trade log. We can see that since I started demo trading, I've had 16 losing trades and only 4 correct trades. But since I started actually trying to follow a trade model, I've had 1, 2, 3, 4, 5, 6 losing trades and 2 winning trades, right? So I'm kind of in a little bit of a rut, which is totally normal because it's the beginning and I'm just starting. This is only my first month actually pushing buttons trading ICT. So I don't expect to get it all right in the beginning. I expect to face some adversity. I expect to get it wrong. But the most important thing is that I make mistakes and learn from them, which is what I'm doing. I'm journaling the shit out of everything, literally everything. I'm doing 2 hour reviews at the end of every single session. I'm going back in, I'm extracting all my lessons, and it's going great. I'm just getting better consistently every single day. And one thing that I've discovered today that is very, very encouraging as you go out through your learning process is putting the date in the top right corner or top left corner of your journal entries. Because today, as I was working on refining my approach to the New York morning session, I went back to my old journal entries on trying to refine that approach and define it. And it's crazy how far I've come. Like now, my approach to the New York morning session is getting very, very specific and well defined. But if I go back to my old journal entries, I can see it was very broad and I didn't really know what I was looking for. But it just keeps getting more and more and more defined, which is basically the process of building a model, right? Initially, you start out, go to the charts. You have no idea what you're looking for, which is why you have to trade in a demo because you got to put yourself in an environment where you can get it wrong. You can get it wrong as many times as you want because there's no money on the line. So there's no financial ruin taking place. You're in the perfect harmless environment to get it all wrong. So I highly recommend putting the date on your journal entry so that you can go back and refer back to them and see your progression throughout your learning curve. It's very, very encouraging to see how far you've come in really only a short period of time. If I go back to my journal entries from a month ago, man, like I've come a really long way. And it's very encouraging. And it just fuels a fire inside of me to keep going and keep pushing every single day. Because although I'm not yet profitable, and although I still don't even have a 50% win rate, I can see that yes, I am getting better simply by referring back to my old journal entries. So that is something that I definitely recommend doing. That will keep you going. That is literally fuel for your journey. It keeps you going. All right, so let's get into today's review. Coming today, my bias was bearish. Why? Well, if we start on the daily time frame, we can see that here we have Monday's range, the down close candle. Tuesday takes Monday's low and distributes higher. So what does this look like? A classic week buy profile, a classic buy week. That's what they call it, right? Weekly profiles. Haven't really studied them much, but I know that Tuesday usually forms the high or low of the week. In this case, we can see that Tuesday forms the low of the week. And look what we're also reacting out of, that weekly buy side imbalance, sell side inefficiency. Also reacting off of the lower quadrant of this weekly wick, which we treat as inefficiencies. We treat wicks as if there were a fair value gap, right? So if we drop quadrants on this, we can see that price is respecting the lower quadrant perfectly, literally almost to the tick. And that forms the low of this weekly candle. We can see that we closed above this weekly buy side imbalance, sell side inefficiency. So what does that indicate? Strength. And given the fact that we have US presidential elections coming up, we know that they're just going to prop this thing up because everybody thinks that the stock market is a measure of how the economy is doing, right? Stock market go up, economy good. Make a president in office look good, right? Simple logic. So you have all this information pointing to higher prices. If we go back down to the 15-minute time frame, we can literally see as a very, very similar daily profile in today's session right here and in yesterday's session. It's basically what do they call it? A New York, not New York, London manipulation, I think you could call it, right? Where London forms the low or high of the day, in this case the low day. But we can see how we take the previous day low, which is this low right here, take the previous day low, trade down into that weekly buy side imbalance, sell side inefficiency, respecting the upper quadrant, which is what you would want to see. We don't want to see price trade down into the lower quadrant because it already did the work down there. So if we were to return back to it, we'd want to see it stay in the upper quadrant, which it does, and then we distribute higher. So this profile is very similar to today's. It's literally the exact same thing, where we have an original consolidation, we drop down, we have this trend line liquidity right here, low resistance liquidity. Initially, we drop down, take the sell side liquidity first, trade into that weekly buy side out, sell side inefficiency, smart money reversal in the London session, then we begin distributing higher. Look at these large up close candles. What does that indicate? The market is now strong and it's seeking buy side liquidity above old highs, which would be here and here. Now, if we notice what we did in yesterday's session, we came just shy of the previous week high and we failed to deliver to it. So what does that do? Well, that is priming liquidity, which means it is engineering more buy side liquidity, because you have a lot of traders who are short off of this high with their stop loss above these relative equal highs, right? When the market comes just shy of where they have their stop loss but turns away, they get a sympathetic sigh of relief. They almost got stopped out, but they didn't. So they're like, whew, we almost got stopped out, but we didn't. We're good. No, you're not, because this thing's just going to run it at a later point in time. And you also see price returning back to this area, and you have a lot of traders who, view this area as maybe an area of supply, and they're getting short off of this area. Like for me, when I used to trade supply and demand, this would be an area of supply, right? So when a price comes up to it and I see this reaction off of it, I'm probably going into today looking for lower prices because I just don't know how the market actually moves. I'm just uninformed, right? And that's how I used to trade it. I spent $2,000 learning supply and demand just to learn that it's all basically bullshit, studying ICT for free on YouTube. So that was very eye-opening, and that was pretty awesome. I left everything behind. I put over a year into supply and demand and order flow trading. I spent $2,000 on that shit, and I lost, say, I think over $2,000 trading supply and demand as well. And then I dropped all that, left all that behind, started trading ICT, and now I can really see how the market moves. And I really believe that this is the most efficient way to view the marketplace. So, as I was saying earlier, yesterday's profile very similar to today's, where we simply have an original consolidation. We drop down. This is the Asia's range as well. So this is simply a perfect London manipulation daily profile. Look at Asia. It ranges as it should. Ranges. We drop down, take the sell side liquidity first. We have a protraction lower. We have a smart money reversal in the London session framed off a daily PD array. We go to the daily time frame, we can see that we have this down close candle. So what would that act as? A bullish order block. Okay, so you extend the open price of that out in time, and we go to the London session, we can see that we have a nice reaction off of it, showing a smart money reversal, right? We also tap the rejection block right here. Look at that. So we have a nice reaction off the rejection block down here as well. Straight into these wicks. Treat wicks as inefficiencies. Smart money reversal, and you notice these consecutive series of up close candles just consistently pricing in higher highs. So what does that indicate to me? The market isn't a buy program. It is very strong. It is now seeking buy side liquidity above old highs, which would be where? Here, here, and here. And the previous week high that we primed in yesterday's session. We came just close up to it and then turned away. So I can clearly see that we have a smart money reversal in the London session framed off that daily order block. Nice rejection off the rejection block. Now trading higher, okay? So it's Wednesday. If we think in terms of weekly power of 3, Monday we had our drop down, right? Tuesday we manipulated Monday's low and then started distributing higher. So what can we expect Wednesday? More distribution higher. Monday initially drops down, forming the wick on that weekly candle, right? Tuesday manipulates Monday's low, forming the low of the week, also part of the wick of that candle, that weekly candle, and then begins to distribute higher. Now, what can we go into Wednesday expecting? Wednesday is usually a higher probability distribution day. And given this information that we see in the overnight session, we have a smart money reversal in the London session. I'm thinking the low day is in, especially after seeing this price action right here. And now I'm thinking that we'll reach into the previous weekly high, because look how close we are to the previous week high, right? We're in very close proximity. It's not like we're just going to come just shy of the previous week high, turn away from it, and never ever see it again. That just doesn't happen. The market doesn't come just shy and stop right here without running a very key area of liquidity on purpose. Is it? I mean, yeah, it does do that on purpose. It's engineering more liquidity, but it's it's not a coincidence, right? There's a rhyme and a reason behind this. There's a reason it's doing this. This is just engineering more liquidity for that to be ran at a later point in time. And since we're in close proximity to the previous weekly high, well, it's very clear and obvious that the market's going to draw up into that area of liquidity. So that's what I was thinking coming into today's session. Now, I start the New York morning session at 7 o'clock in the morning, which is right here. Right here. Boom, on this dash line. And what do I see? Coming to the charts, I see how we run this pool of buy side liquidity right here. Right there. And at the same time, we're also failing to traverse the new day opening gap. So this is information that I read, or that I failed to read in real time. Because how I want to approach the morning session, when I see a smart money reversal in the London session, a clear market maker buy model, higher time frame market maker buy model, right? We have our original consolidation, protraction lower, taking the sell side liquidity first. So the buy side liquidity is going to be next, okay? But when we run this buy side liquidity here, I'm not thinking that this is the start of an entirely new move. Why? Because we have an unfulfilled objective from the weekly time frame that price has yet to deliver to. And given this information down here, I'm thinking the low day is already in. And I'm thinking that price is going to jump right to its weekly objective from the weekly chart, which is the previous weekly high in that pool of buy side liquidity that we primed in yesterday's session. So when we run this external range liquidity, I'm not thinking the market's going to sell off and run these lows down here, because this is the objective. And given that it's Wednesday is a higher probability distribution day, and all the information that we're seeing in the overnight session, I simply view this as a retracement back down into a discount to then continue higher. So what I've learned in my approach to the New York morning session is that when I see something like this and the market runs buy side liquidity or minor buy side liquidity on the 15-minute time frame, I don't view that as a start of an entirely new move, because the higher time frame market maker buy model has still not delivered to its terminus. So I simply view this as a retracement back down into a discount. I want to look for a higher time frame PD array that I could potentially frame a reversal off of, and I want to look for a short-term discount to get in sync with what is in motion. I'm not viewing this as a start of a new move. I'm viewing this as an opportunity to get in sync with the move when the market visits a short-term discount, which in this case, if we go to the hourly time frame, we can see that we have this 1 hour buy side imbalance, sell side inefficiency, or bullish fair value gap, right? So we can use this PD array to frame a long setup to get in sync with this move. Now I'll explain where I went wrong today, okay? Now I thought that price was going to run this high right here and then drop down into this inefficiency right here and then trade higher. The problem with this was that it was in a premium. So basically I bought a premium. Anytime you buy a premium, you are asking to lose, because the market's going to have a deeper retracement against you that's going to stop you out. And that's exactly what happened here. If I frame the dealing range from the inception of this move, which is basically the start of the move, to where I think price is going to go, that is going to give me my dealing range. This is how ICT taught to frame a dealing range in the 2024 mentorship. He said you start, or you mark the inception of the move, which is the start of the move, and where you think price is going to deliver to. So if I think price is going to deliver to the previous week high, this would be my dealing range. And that midpoint right there, you can see the midpoint, that would be, below that would be a discount, above that would be a premium. So if I'm looking to get long, I want to buy in a discount. Now, as you can see, if I'm buying in this inefficiency right here, that's in a premium. So what does that make me prone to? That makes me prone to a deeper retracement back into a discount that I can't weather, that I can't tolerate, which is going to knock me out of the market. So what I want to do is wait for a discount. So if I see this information in the overnight session, smart money reversal in the London session, now price is distributing higher, it's very clear that we are on the buy side of the curve in this market maker model, and I'm thinking we're going to deliver to a weekly objective, then I first want to frame my dealing range and look for a discount. Where is there a discount? Because I want to buy below that. And then once I know where a discount is at, which is essentially right here, it's kind of in the middle of the range, right? Let me just put this on here. We'll just do this. Okay. So I'm framing my range right there. Now if I go to the hourly time frame, it's not on there. Let me change the visibility. There we go. So if we go to the hourly time frame, we can see that this imbalance is below a discount, right? So that is where I want to look to frame a potential long entry. Now, that is why this trade simply stopped out, because I was buying a premium, which is just asking for a retracement that I can't tolerate, which does reprice to a discount. Then it is valid to look to long the market. But I couldn't tolerate this move because I was buying way too high up in a premium. Okay. So if I drop down to the lower time frame, and look at this, I've been exploring macros and market maker models and mashing them together, and it's just really been opening my eyes on how the market sets up, which I can explain. But let me break down this trade first. Let's put on the executions. Trading panel. So we can see that since I started actually trying to follow my model, we are now in what? A 1/4% in drawdown on a $100,000 account. So today I took some trades. Some of them are green, some of them are red. I'll get into those later. If I have time in this video, it's already 15 minutes long. But yeah, we're in a 1/4% drawdown, so we were able to come back a little bit, which is good. Now in this trade, I noticed how, let's see. So here's where we ran that external range liquidity, right? That high on the 15-minute time frame right here. And this led to that deeper retracement that repriced down to that hourly imbalance. Then it was valid to look to long the market. But this was too high up in a premium relative to the dealing range, so it was not valid to look to get long up here. And I was looking to get long off that 15-minute imbalance right here. Right? If I go back to the 15-minute time frame. 15-minute time frame. I was trying to get long in this, okay? Back down to the 1 minute. The problem with this was what I already outlined, right? So when we dropped down into this, I was looking for the market to clear out these relative equal lows, then begin to trade higher after dropping down into this 15-minute imbalance. As soon as this was inversed, that's where I got my long entry. But you can notice that there was a lack of displacement off of this inversion fair value gap. Usually when I see a fair value gap inverse, I'd probably want to see it do something like this, right? Where we have one single pass here, and then boom, large downrange candle that just completely overlaps the entire thing. Now compare this to this reaction right here, where it's not like that at all. Don't see a very sudden, quick, energetic move. It kind of just slowly meanders its way out of the sell side imbalance, buy side inefficiency. So I would not consider this a high probability inversion fair value gap based on how price is failing to show displacement out of this inefficiency. And then we really saw no reaction to this thing at all, except maybe right here. But we reacted off the balanced price range above, and then we sold off, rolled lower into a discount relative to the higher time frame dealing range, traded down into the 1 hour buy side imbalance, sell side inefficiency. So that trade was incorrect. Now I have to review these other ones before I run out of time in this video. I want to keep it at like what, 24 minutes. Okay. So my bias on the day was bullish, as I've mentioned many times now. So I notice how we have a smart money reversal right at the 9:30 open, but notice how we leave these relative equal highs above the marketplace. So because my bias is bullish, I'm simply looking for the market to trade down to a short-term discount, like I outlined before. I want to see it run some minor pool of sell-side liquidity and then show me my long setup. I want to see my entry model, right? But here we leave these relative equal lows, 9:30 open, trades higher, and this is my entry model right here, where I have a breaker, right? We have a high, a low, a higher high, and then a lower low. And that first inversion fair value gap in the price like that does the stop run. That is my entry. Now we can see that the 9:30 candle literally opens, trades up into that, and then closes below it. That's the algorithmic signature of weakness. And that, following that is this. That's exactly what you want to see. This is exactly how you want to see the market react off an inversion fair value gap, not like this, right? Compare that. Compare the two, literally. This, okay, look at this reaction, and then look at this reaction. You see that? This is what you want to see. You don't want to see this very slow, very meaningless reaction, okay? And then we leave the first presented fair value gap. And I know that I am long. So if my bias on the day is bullish, I'm viewing any move lower as a Judas swing or the fake move to get retail traders thinking this thing is going lower right at the bell, when really my daily bias is bullish and I'm thinking this thing is going higher. So I'm viewing this move lower as the market simply repricing to a short-term discount, taking or accumulating sell-side liquidity, accumulating sell stops, and then it's going to start distributing higher. moving towards that weekly objective that we outlined on the higher time frame. So this was a quick little scalp selling short to the first presented for value gap, targeting this short-term low right here. So that was a quick little scalp for, I think, a little under 20 handles. And then I got a little too confident on my read on today's market. And then I kind of did the same thing where I got long off of this inversion fair value gap right here. Or was it this imbalance right here? Well, I saw we have an inversion fair value gap and a fair value gap right here. Those two are kind of overlapping. So I put a buy limit order here because this is an inversion fair value gap and a price leg that has a stop run. That's usually what I use for my inversion fair value gap entries. But I noticed how this candle just rolled right over this buy side imbalance, sell side inefficiency. It was coming trading lower for the lows down here. So I pulled the trade off early. My stop loss was originally below this low, somewhere down here, right? A couple ticks below the low. But I saw us just roll over this, so I took the trade off early. Now that led to this trade right here, because when I took the trade off early, it never hit my stop loss and then started distributing in my favor. See large up close candles moving in my favor. So when I see this, after the fact that I took my trade off early, I'm feeling a bit of FOMO, and then I'm thinking, how else can I get in sync with this move? Because I think that the smart money reversal has occurred down here, and now we're going to start moving higher, moving towards that objective on the daily chart, weekly chart, that higher time frame objective. So I then try a long off of the first presented for value gap. Once we trade back through it, I was going to take it long up here and then see if we could trade up to the weekly objective, right? Now the problem, or why this did not work out, both of these trades were not bad ideas. It was simply the fact that we had a very small opening range gap, which is the difference between yesterday's settlement price at 415 and today's open at 930. If I toggle this setting in the bottom right corner, we can go to regular trading hours and we can see that we had a relatively small difference between where we settled yesterday at 415 and today where we opened today at 930, right? So when we have a small opening range gap, that makes the market conducive to experience high resistance liquidity conditions, meaning it's likely that we're going to see high resistance liquidity conditions. And a characteristic of high resistance liquidity conditions is the market simply coloring outside the lines, not necessarily respecting PD arrays. It faces high resistance running to obvious areas of liquidity. So I noticed how we took out the short-term low down here, and I was thinking the market was going to run for these relative equal highs up here that it left, as well as the weekly objective, right? But it had a very hard time doing so simply because we had that small opening range gap. And you notice how we kind of disrespect the first presented for value gap. We just trade right through it, back below it. That is characteristic of a small opening range gap type morning session. Now, it wasn't until we ran these relative equal lows. So if you notice how this plays out, we leave relative equal highs down here, drop down, take the minor sell side liquidity below there, leave relative equal lows down here. So people are long off this low like I was, right? So that's engineering more sell side liquidity underneath this old low. This trades up, does not run this pool of buy side liquidity. So what does this do? Primes liquidity, exactly as I outlined, but just on a lower time frame. It's literally what I outlined, what happened to the weekly high, but on a lower time frame. It's the same thing. Markets are fractal. And then it's not until we run these relative equal lows that I see a long setup on the 15-second time frame where we simply have a model 2022 entry where we run liquidity and then we have a market structure shift. I take the market long in the first inefficiency. Your stop loss has to tolerate and move down into the second inefficiency. So my stop loss is below the low right here, and I was targeting very, very low threshold objective because I have to work on disciplining myself to take off at low threshold objectives, which was the new day opening gap low. Took off there for what, a little under 30 handles. So that's something that I have to work on because a big flaw of mine is that I've been greedy recently. So I have to discipline myself to take off at low threshold objectives, develop that self-control, develop being content with taking off at low threshold objectives, because really that's what I'm going to do in every single trade that I take. When I start trading multiple contracts, majority of my position is coming off when I'm up 30 to 40 handles in a position, maybe even 50, right? So I have to discipline myself to take off at low threshold objectives. And this was the good setup for the day. Now notice how we had that small opening range gap, right? So what do we see? High resistance liquidity conditions. The market hangs around, has a very hard time running to the obvious areas of liquidity. We can see that it kind of just hung around here, just chopped. This is a characteristic of high resistance liquidity conditions. In high resistance liquidity conditions, like I said earlier, the market has a hard time running for obvious areas of liquidity, and you're going to see deeper retracements than what you're comfortable with. So what I've noticed, me personally, every time the market experiences high resistance liquidity conditions, that makes me very uncomfortable when I am in a position, because it just takes so long for it to play out. Even though it's a valid setup, I didn't do anything wrong. Because of the high resistance liquidity conditions, I experience deeper retracements against me that I am comfortable with, and it takes way too long to deliver to my objective. The delivery is very, very disgusting. And that's what I learned about how high resistance liquidity conditions make me feel when I'm in a trade. So you notice how I feel in like all these different situations, right? These are things that you have to journal. These are things that you have to track, because they're going to happen again and again and again. You have to know your weaknesses. You have to know your strengths. High resistance liquidity conditions are a big weakness of mine. But today, once I realized that the market was in high resistance liquidity conditions and the market was just simply having a hard time running to my objective, although I took a good setup and it wasn't a bad trade idea, given the conditions, it just took so long to deliver. It was very, very sloppy. All right, so this video is getting too long. See ya.